really appreciate Congress doing that. We're in a transition phase, and we see that banks are now moving off LIBOR, as they've been required to do, with a clear end date to when it's going to be produced. And I think they're making good progress in transitioning to SOFR. I'd say the progress is a little bit less good when it comes to loan products. That the progress has been very good on derivatives. We do think it's important that banks choose indices that are robust based on strong data. We have some concerns that we mention in the FSOC report over credit-related indices that banks may use, but generally I'd say the transition is going well.
Okay. Thank you. Thank you, Mr. Chair.
Thank you, Senator Tull. Senator Warren from Massachusetts is recognized.
Thank you, Mr. Chairman. In the crash of 2008, we saw how financial institutions that were not banks could be big enough and risky enough to bring down our whole economy. It was the collapse of a few non-banks, the investment companies Lehman Brothers and Bear Stearns, the insurance giant AIG, that triggered the crisis and caused millions of families to lose their jobs, their homes, and their retirement savings. Now, in response, Congress created FSOC to prevent such a crash from ever happening again. And one of the most powerful tools we gave to FSOC was the ability to designate non-bank firms as, quote, systemically important financial institutions, or SIFIs, and subject them to the same oversight as the big, too big to fail banks. Today, these non-bank firms include asset managers that oversee trillions of dollars in assets, exceeding the GDPs of just about every nation on earth, mortgage companies that originate 60% of home loans in the United States, and hedge funds, private equity firms, and investment companies that operate in the shadows of the financial system. Those companies control huge amounts of the U.S. and the worldwide economy, which means their mismanagement or failure could threaten the entire economic system. Even so, in 2019, under the Trump administration, FSOC issued revised guidance that significantly weakens the Council's ability to conduct this oversight. But don't take my word for it. Secretary Yellen, you, along with Fed Chair Ben Bernanke and former Treasury Secretaries Tim Geithner and Jack Lew, wrote a letter in 2019 opposing the revised guidance. You stated that the changes would, quote, neuter the designation authority, close quote, and, quote, amount to a substantial weakening of the post-crisis reforms, end quote. You also say that the 2019 guidance would, quote, make it impossible to prevent the buildup of risk in financial institutions whose failure would threaten the stability of the system as a whole, end quote. That sounds pretty serious. Do you still agree with that, Secretary Yellen?
Yes, I do.
Good. Under the Trump administration, regulators chipped away at the rules bit by bit, leaving our financial system and American families less safe. Restoring FSOC's ability to prevent giant corporations from taking our economy down again is a critical step to building those defenses back up. So, Secretary Yellen, you have already joined others to say how dangerous you think it is that the 2019 SIFI guidance change was, and now you have the power to do something about it. Will you reverse the risky 2019 guidance this year?
We're looking at this very carefully and examining what our options are. We'll be discussing this with other members of the council. So I continue to hold the same set of views. But I do want to say designation is not the only tool that was given to FSOC to address financial stability risks in the non-bank financial sector. Activity-based regulations are also relevant. And so there are two kinds of tools. Sometimes designation is clearly the right tool when there is an institution whose failure could threaten financial stability, it's the right tool. But sometimes, and I would give you money market funds as an example, there is a practice that occurs throughout the financial sector. Many firms are involved in it. The risk comes from the activities or the structures that many firms have that risk. In situations of that sort, an activity-based approach may be relevant. And I want to say that FSOC has been very focused ever since the day I became Treasury Secretary on risks in the non-bank financial sector. We have focused on money market funds. We have focused on open-end mutual funds where there can be run risks and hedge funds. And an activity-based analysis or potential regulations in all of these cases from the SEC or further data gathering, I think that's the right approach there as opposed to
I appreciate that,
designation.
Secretary Yellen, but we're going to run out of time here. I just want to remind you, though, I will quote Yellen to Yellen on this. The letter you co-led said, quote, activity-based approaches cannot address risks that are tied to the funding, leverage, and combination of activities within a corporation, end quote. It also says, quote, Congress created the FSOC with both designation authority and the authority to review and make recommendations regarding activities. Congress did not intend for one authority to be used as a prerequisite for the other, end quote. My only point here is that with that 2019 designation that you wrote this letter against, it has altered that balance, and I want to see that balance come back into play.
I agree with that. I think both tools should be available, and one should not be a prerequisite to another, in my view.
Good.
But we need both tools and hope to look
I want
very
to see both as
carefully
well.
at the designation.
Stronger rules to protect our economy. Always good.
Thank you, Senator Warren.
Agreed.
Senator Kramer of North Dakota is recognized.
Thank you, Mr. Chairman. And I cannot resist getting back to the issue of energy. You said a couple